In the next 9 minutes, I'm going to walk you through every single ICT concept that actually matters if you want to trade profitably. I personally wasted years grinding through this stuff the hard way, but everything shifted the moment I built a focused, no-fluff breakdown of the only concepts that genuinely move the needle. So if you're someone who's not just looking for theory, but wants to actually apply what they learn, then you're exactly where you need to be. Let's get into the first concept right now. Before we go any further, I want you to make one commitment. If I break ICT down so simply that it finally makes sense to you, can you promise to stay consistent and not overcomplicate it? If that's a yes, then stick with me, because today we're covering everything. Liquidity, market structure, market maker models, the power of three, how to build it all into a real strategy, and which timeframes belong to each step. First up is liquidity, and this is the absolute foundation that everything else in ICT sits on top of. The core idea is this: price is always drawn toward liquidity, because that's where the highest concentration of stop losses lives, and the large institutional players use those areas to accumulate positions at the expense of retail traders who get hunted out. There are two primary forms of liquidity you need to know. External liquidity sits at swing highs and swing lows, and internal liquidity lives inside fair value gaps. Now, if you're not familiar with a fair value gap, it's simply the empty space created when a large aggressive candle moves so fast that a gap forms between the wick of the candle before it and the wick of the candle that follows. That space between those wicks is your fair value gap. Always think of price as being pulled like a magnet from one liquidity pool to the next, from internal range liquidity to external range liquidity. Once price has swept from a fair value gap all the way to a swing point, if a new fair value gap then forms, you should expect price to retrace back into that gap. And once it does, the expectation is for it to then push toward the next swing point. This is simply how markets cycle, constantly rotating between one source of liquidity and the next. You can see this clearly here, as price works its way up to this high, and the cycle continues from there, because this is the underlying architecture of how all markets move. Liquidity is the engine, but to actually trade it, you need one more tool, and that's market structure. If you had a reliable signal that told you when a trend was genuinely ending and when it was simply pausing before continuing, would that completely change how you approach your trades? That's what market structure gives you. At its core, market structure is just a sequence of highs and lows. But here's the key: not every high and low carries the same weight, and that's where the concept of manipulation and displacement becomes critical for knowing which ones actually matter. First, let's define what qualifies as a legitimate high or a low. A valid low has higher lows on both sides of it, so you're looking at a three-candle formation where the center candle is the lowest point, with higher lows flanking it on each side. A valid high is the opposite, lower highs on both sides, making the center candle the peak. Now, what price does at those highs and lows tells you everything. Notice right here what's happening at this low and this one. Price is approaching but not closing below it. Now, some traders would call this a break of structure, but that interpretation is incorrect. When the market doesn't displace energetically through a structural level, meaning there's no forceful, committed push, a reversal is far more likely. This probability increases significantly when you also get a market structure shift. A market structure shift simply means that after making lower highs and lower lows, price creates a genuinely new higher high. And what makes that higher high valid is that it was created through a fair value gap and price closed beyond that structural point. You can pair this with liquidity sweeps or key level taps, which we'll get into shortly. A useful additional trick here: anytime a low gets manipulated, meaning price dips below it without energetic displacement and then reverses, you can use the high that preceded that move as your target. Because that high had one job, which was to push price lower, and it failed. That failed high now becomes a magnet. Now that you understand both liquidity and market structure, let's combine them into the actual framework for making money with these concepts. And that framework is called market maker models. If you've ever had a setup that looked absolutely perfect only to get stopped out right before the move launched without you, this concept is going to explain exactly why that keeps happening and how to stop it permanently. I genuinely can't overstate how important this is. Just imagine what it would feel like to stop being on the wrong side of these stop hunts and start anticipating them instead. We know that price moves from fair value gaps towards swing points, but how do you position yourself to capture that move? On the higher time frame, price appears to sweep cleanly from a fair value gap straight up to liquidity, but if you drop down to the lower time frame, you'll see the real story. What defines a market maker model is the presence of two or more consolidation phases on the path down into your higher time frame fair value gap. Consolidation just means price moving sideways, building up orders. Many traders will try to get in early during these consolidation phases and will get stopped out when price briefly dips under each one. What you actually want to see, once price arrives at your higher time frame fair value gap, is a manipulation. A push below the range, followed by a strong displacement that creates a new, lower timeframe fair value gap. That new lower timeframe fair value gap is your entry point, and your target is that higher timeframe swing point. This lets you ride the full move from internal to external liquidity. there's an added bonus here as well. Once this setup is active, anytime price dips below a recent low within the move, if you're positioned long, treat that as a likely manipulation rather than a reversal signal. You can use those dips to catch later entries into the same setup or to trail your stops tighter to reduce your risk exposure. Let's look at this example. We have a first consolidation, then a second one. At the bottom of the range, we see the manipulation, followed by a strong displacement through a prior high. At that moment, you'd look to go long using one of the entry models I'll show you in just a minute. And every time price dips under a recent low from that point forward, you'd interpret it as a false move, a shakeout before price continues its push upward. Remember? It's always a higher timeframe fair value gap, giving you the setup, and a lower timeframe market maker model giving you the execution framework. Now here's something I spent a long time figuring out. I used to review my trades and couldn't understand why some of them exploded beautifully while others barely moved at all and just dragged along. The concept that answered that question for me is called the power of three, and it is one of the most impactful ideas in all of ICT. This concept alone helped me generate $41,000 in a single trading day. The power of three is straightforward. It states that markets move through three phases: accumulation, then a stop run, and finally a directional expansion. You can see it clearly here. Price builds this accumulation phase, which is essentially a consolidation. If we're in a bullish context, what follows is a stop run below the accumulation, targeting the lows. On that particular day, I waited patiently for those lows to get swept, and once price gave me a clean re-entry pattern back inside the range, I knew the opportunity was extremely high probability because the market was primed for a large directional move. That's exactly how I used the power of three to capture that $41,000 day. But knowing the concept isn't enough. You need a precise entry model to actually execute it. Let's get into those right now. And I want to be completely transparent with you here. Without a defined entry model, everything you've learned in this video up to this point remains purely theoretical. You can't act on it consistently without one. So I want to ask you something honest. If I handed you a clear, repeatable entry setup right now, would you actually commit to using it with discipline? I'm going to give you 3 entry models, but before we get into them, there's one non-negotiable rule. If there is no key level being tapped, there is no trade. Full stop. That filter alone ensures you're only ever taking setups with genuine edge. Look at this example. Price has traded into this liquidity area, but there's no displacement. No fair value gap was created. That absence alone signals that price is likely to rotate back up toward the high that failed to create a new lower low. That high can be treated as a key level, specifically as external range liquidity. And if there's no fair value gap in the middle of this range, then the market is expected to travel from one liquidity zone to the other. On top of that, notice we're also trading inside a higher timeframe bullish fair value gap. When price is touching 2 key levels simultaneously, that's when you drop to the lower timeframe and begin looking for your entry. The first entry model is the inverted fair value gap. Once price has reached a key level on the higher timeframe, as we have right here, you watch for fair value gaps forming on the way down into that level. Notice right here, there was a fair value gap. And then what happened? A candle closed through it. That tells you the market is responding in a bullish way, because if it were truly bearish, that closure would not happen. When the market is printing bullish behavior at key levels, the probability of an upward move is high. So at the close of that candle, you could place your long entry, set your stop at the most recent swing low, and target the higher timeframe swing point above. Always make sure you're getting at least a 2-to-1 risk-to-reward ratio on any setup before you take it. When a key level and an entry model align, you can enter with genuine confidence. And as you can see, price does exactly what the setup suggested. Now, 2 additional entry models presented themselves in that same scenario, and the first is the change in the state of delivery. Let's say you missed that first entry. What are you looking for next? A change in the state of delivery. Watch this downward sequence. You have a chain of bearish candles completely dominating the structure, engulfing every bullish candle that attempts to form. Even this group of bullish candles fails to reclaim the bearish momentum. But then look at what happens. The market prints a bullish candle that fully engulfs that entire downward sequence. That right there is your change in the state of delivery, and at that moment, you enter the trade. At the same time, a market structure shift is also occurring. Price takes out this high and creates a fair value gap through it, which is a second, simultaneous confirmation. Either pattern alone is a valid entry, both together is exceptional. So for any of these 3 entry models, the inverted fair value gap, the change in the state of delivery, or the market structure shift, your execution is the same. Enter when the pattern confirms, stop goes at the most recent swing low, and your target comes from the higher timeframe analysis you already completed. Now, timeframe alignment is critical to making all of this work. The list I have here is organized from the key level timeframe down to the entry timeframe, meaning if you're working with a weekly fair value gap or a weekly swing point as your key level, you would then use the 4-hour chart to identify your market maker model and your entry pattern. Take a screenshot of this framework so you have it as a reference for building consistent, structured trades. You now have everything you need to trade ICT concepts like a professional without burning years, learning it the hard way, and without getting buried in the overcomplicated, contradictory material that floods this space. If you want to go deeper and learn my complete trading system from start to finish, the link is in the description below. Make sure you subscribe as well. Most traders lose because they're learning the wrong things. I break down what the institutions actually do, so you stop being the liquidity. Follow for the next setup. It might be the one that gets you funded. Hooded trader. Decoding the markets. Getting you funded.